Welcome back to Don't Flip It, Rent It.
We got a special treat for you. Our producers have found us a couple of contractors that are going to throw in some construction tips as we talk about real estate. In the kitchens, we keep things simple.
New appliances, we got a recessed sink.
Hey, I wouldn't do that if I was you. Daryl's cousin washed his teeth and his feet in that sink just about an hour ago.
Outdoor spaces are very important. You want to keep them clutter-free.
Fresh, clean, and neat, and very well maintained.
Hey, I tell you what you should do right over here. You should put in one of them above ground pools. Daryl's grandma, she's got one in her backyard, man. It's legit. She skinny dips in it all the time. It's awesome.
As far as the flooring, you don't have to rip the floors up. If you have beautiful hardwoods underneath the existing flooring, you may be able to repair them.
Just a little love and attention and...
Wood floors, you don't want to do that in here. It don't make any sense at all. What are you doing? You want to rip the floors up, put some of that shag carpet down in here. Daryl, he has parties over here all the time. They sleep on the carpet for like 48 hours straight, man. Put it in, trust me.
Dude, we can't do this, man. These guys are ridiculous.
Dude, I told the producer to get two guys that are good.
Good? These guys don't know up from down, man. They can't operate like this.
This is deeply hurtful. My studies at Oxford did not make me ready to tolerate this.
Hey everybody, before we start the show, we actually have an outline that goes with the episode that you can follow along with as you listen. You can find that on our website on the podcast tab down on the blog section. And while you're there, also check out the education tab that has some resources to help you save some money and learn a little bit about investing. Also, while you're there, check out the merchandise tab and check out this sweet new merchandise we got so you can rep the Homeboys everywhere you go. Enjoy this episode. Happy investing.
Everybody, you're kicking it with the Homeboys and the Homeboys podcast. My name is Clint Wetherill. We have a really exciting topic. We are talking about rental properties and how to profit from them. Anyone can just get rental properties. We're talking about what you have to do to actually profit from them. As always, here with my good friend, Mr. Scott Adams. Hey, brother, what's happening?
I'm excited. Today we're going to talk about why you should invest in rental properties, and we're going to even use an example property that we sold a client 10 years ago. We're going to break that down, show you what he's made since purchasing it and what it's worth now, and go through those numbers. We're going to talk about when you should invest, which I'll give you a sneak peek. The answer is always now. And then last, we're going to talk about how you should invest, and we're going to make that part real simple, which is if you have never purchased a rental property, we're just going to give you the quick, short answer on how you can do it. It's really easy. But before we dive into that, how are your rental properties doing, my friend?
You know, they're doing well, and you know the main reason why they're doing well is because I stay out of them and I let our team of people here run them, and everything seems to go better whenever I keep my paws off of them. But I found this topic pretty cool to think about because it got me kind of going down memory lane. And, you know, whenever I got started in real estate, I didn't know, how to profit from a rental property because I got into real estate thinking that I was just going to be a house flipper and try to hoard cash and thought that was the way and the only way. And I became a rental property owner, by accident. We went through the Great Recession. Our houses stopped selling, and next thing I knew, I had 25, 30, rental properties. So, I got into it not even really knowing how to profit from rental property. So I think this is an important topic for everybody because, I said, in our little intro there that, anybody can just, get rental properties, but you have to really know the ins and outs of finance and, taking care of a property. And we're kind of going to get into that,
Sure.
a little bit. But
Sure.
this is something that whenever I first got into real estate, it took me a while to learn.
Well, for me, when I first learned this information that we're going to go through, and we're going to break down a property and show you the different ways that you profit over time, and there's multiple revenue sources that come to you as a rental property owner. And as we go through those, I'm remembering back to when I was in college and someone explained this to me. I was lucky enough that we had a family friend who owned a lot of rentals, and they explained this to me, and my mind was blown. Now, I applied that knowledge very poorly in my 20s. I purchased the wrong types of properties that tenants don't actually pay their rent. I bought ghetto properties, as you know, and built up a entire portfolio based on the knowledge of what a rental property can do, but with the wrong properties, it doesn't work. So I have a mixed road on this. But when I learned this stuff, it blew my mind. And I think even kind of intermediate investors who own rental properties, I think they forget some of the benefits to the properties themselves. That it's nice to be reminded, because you've got, not only do you make profit on rent each month above and beyond what your mortgage payment is, but the tenant is paying down your mortgage for you. You also have appreciation. Now, that's never guaranteed. However, anyone who's owned properties for anywhere longer than 10 years knows that it's over any 20-year period, appreciation happens. And if you've owned them lately, then you really know how appreciation works. And then last, there's everything from tax benefits and then the generational wealth building that this creates. And not only is the tenant paying your mortgage down, to touch back on that aspect, the tenant's not only paying your mortgage down, but the way mortgages work is more of your money at the beginning of the loan goes to interest than principal. And that switches over time, where you are paying your mortgage down in an accelerated rate. So towards those sunsetting years of your mortgage, it's unbelievable how much that of the mortgage payment is going straight into your pocket as principal. And people forget about all those little aspects to it. So they just think about, well, I'm making $200 a month in rent. That's great. That is just the tip of the iceberg.
The why extends so much further than that. Like you said, the tax benefits, and just there's the appreciation that we've seen over the last 10 years. It's mind blowing. We've not seen it in our careers like this. I mean,
right.
It's crazy, and we never sell off of appreciation. We always hammer that point home.
It's the cherry on top.
It's the cherry on top, and it's been a massive cherry, for the last 10 years. But we kind of broke this down a little bit, and I'm going to let you kind of take this over. Yep. I think we think it'd be good for our listeners to hear a real life example of something that crossed our desk from one of our clients. Mm-hmm. And I think this is over a 10-year time period. Yep. What owning a cash flow producing asset will do for a person.
Yeah.
So we have a real life example here.
So in order to pick a property, I literally randomly went into our shared drive where we hold all the files for our sales, and I picked a property. Now, this one has incredible appreciation. So don't count on that. But everything else is pretty much, I would consider, par for the types of properties that we help our clients acquire.
It's hard to say, though. I mean, if you would ask me 10 years ago if this particular property, because I ran some numbers on it before we came in the studio here, I never would have dreamed that I would have seen this kind of appreciation.
Right.
So the point is, you just don't know what. We don't have a crystal ball. We don't know what the future holds.
But I didn't cherry pick this property. This is a pretty standard property. So let's start with 10 years ago. They purchased it for $125,000. They put a $25,000 down payment down and got a mortgage for $100,000. So they took $25,000 of their savings and they invested it into a rental property. They went to the bank, and the bank loaned them the additional $100,000 in order to purchase this. So it only cost them $25,000, and they have their first rental property. Now, their mortgage on that $100,000 was about $800 a month for the mortgage, tax, insurance, depending on your rate. It's actually fairly accurate for today's numbers too. Mm-hmm. $100 for property management expense I put in there, and then I put in $200 for deferred maintenance and miscellaneous expenses. I could dive into the weeds on all of these numbers. I'm not going to. I'm just going to give you the broad picture because this is fairly accurate based on 10 years of managing this property. So it's $1,100 a month in expenses that he has going out. Well, on those first 2 years, he had $1,250 in rent coming in. Not great.
So modest,
Yeah,
modest
$150 a
cash
month.
flow.
Yeah.
So I think it's important to drive that point home because I think, a lot of people will say, "Oh my gosh, $150." I mean, that sucks.
Right.
People think, why would I do that? Well, keep in mind, this is in a great neighborhood with a great school system that offers a lot of security from a tenant payment standpoint. You could look on paper and find, say, going back 10 years, we could have found $400, $500, $600 cash flow on paper, but it wouldn't mean anything because you'd be in a bad area and that tenant stops paying their rent. Then you have to fix the property up. You call it the cycle of death. It's just it's a constant constant cycle. So yeah, $150 sounds bad. However, we could sit here and drive home how good that $150 is compared to some bogus paper return of a property in a bad neighborhood. So I just wanted to touch on that real quick.
It's a good point. We believe in conservative investments in properties that we know and are proven to not only return as rentals, but are also safe places, as safe as you can get in the real estate world. There's risks in everything. Safe investments where we don't expect loss of value and are poised for any appreciation capture that a market gives. So you're getting $1,100 a month, or it's costing you $1,100 a month. That first 2 years, you've got $1,250. Well, here's the good news. Your mortgage stays at $1,100 a month for the life of your mortgage. They did a 30-year mortgage. The next 2 years, it went up to $1,300. The next 3, up to $1,450. Currently, it's at $1,550. So for the next 3 years. So you add what they made on all of that together, and they've made $37,200 in rental profits over the first 10 years. $37,000 in their pocket. So they got all of their original down payment down. They're on house money now. They got all that $25,000 they put down plus some already in profit. But that's nothing. That's just scratching the surface of what they've made. Their mortgage has also been paid down by $18,000. And the tenant's the one that paid that down. They used the rents, obviously, to pay the mortgage down. So they've made over $37,000 in rental profits. Their mortgage has been paid down by $18,000. That's over $55,000 in the first 10 years on a $25,000 investment. Doubling the money in 10 years is great. It's good. Anyone who invests anywhere will tell you good, solid investment. Is it Bitcoin that's quadrupled or times 500? No, but it's a good, solid one. But again, we're still only scratching the surface. Their current home value today is $275,000. After realtor fees, closing costs, and all that stuff that eats it away, inspection, repairs. When you're selling a house, there's all these little things. I was very conservative. I say let's pretend that cost them $25,000. So they only get $250,000 net proceeds at sale. Well, their mortgage payoff is $82,000 because the tenant paid it down. That's $168,000 back in their pocket, plus the $37,000 they already made in rents, plus a great asset that they could hold. But that's a total profit of $205,000. That's if they sold it on year 10. That's if they sold it. That's turning $25,000 into $200,000 in 10 years. Guess what? They didn't sell it. I went through these numbers with them. They didn't sell it. You know why? Because they're going to keep riding this train.
Well, I think it's also important to point out that they keep riding this train. There's some of these numbers get considerably better. You mentioned it about the payoff principal is very little in the beginning of an
amortization.
Excuse me. Yep. Thank you. And it increases over time. So
The first 10 years it paid down 18,000. The next 10, I'm just going to guess, and I need a schedule to do this, an amortization schedule, but I would guess that would be
Double.
35 to 40 would be my guess. The next.
Right.
So it just accelerates. Rents continue to go up. You make more profit each month.
Correct.
As time goes on.
You know, it's amazing because like when you first, I think it's very important for our listeners to take this in. You know, you're talking about a cash flow of $150 when you start out. You know, and in 10 years that has made you $205,000. You know, there's other things that, you know, we're not accountants, so we try to stay out of you know, depreciation and
tax benefits,
and
all of those things,
and all of that. But you know, there's other benefits that could be factored.
That's a great point. I didn't even touch on those with this. They've had tax benefits over the last 10 years too that you could I could have our CPA actually calculate to the penny and add in here. But I don't want to get into the weeds. We're not accountants or financial advisors, so I try not to get too in detail over that. The point is that this is a picture of a property that looks like, oh yeah, I'll make $150 a month. I'll buy it. I'll put $25,000 in it. It'll be cool. I'll have a rental property. No, $150 a month turns into more and more and more and more and more money. This is a escalating investment that just continues to have increased returns year after year. It's one of the main reasons that millionaires, 90% of them have become millionaires through real estate. I'm going to say that again. 90% of people who are millionaires, they didn't become millionaires and then invest in real estate. No, real estate made them millionaires, 90% of them. And this is how. You can see it here. All they did was they took $25,000, they invested in a really low returning property. Let's call it what it is. It was a very low returning property. And it still turned into $205,000.
They say low returning property, but again, great neighborhood. And anytime you can say great neighborhood, that takes a mountain of risk out of it.
That's what we focus on. We do not chase returns here. You know why? Because we don't have to. There's no reason to add so much more risk to your investments when the conservative, good ones perform this well. Why would you try to chase returns? And if you're investing in those crappy ghetto properties that have great returns on paper, you're going to miss out on a lot of the appreciation. It does not happen as quickly or as high in those areas. It just does not.
Right.
And there's just so many risks to it. It's not worth it. So
when would be a good time to get started? When's a good time to invest?
You and I have the same answer for this always.
Right now.
Giddy
up.
Let's
just do it.
I don't care when. You don't care when. We don't try to time the markets. We are long-term cash flow investors. It is always the best time to invest in real estate, and it's never the perfect time. You cannot time the market.
You always have to be analyzing. You always have to have your ear down to the ground. If there is a deal out there, now is always the time. A lot of people right now are saying, "Oh, well, why would I do that now? Because interest rates have gone up 4% since they're low." Who cares? I don't think real estates are going back to that low ever again. I don't think that we'll see it. I think that
even
was
if they
a
are, who cares?
once-in-a-generation thing.
Refinance later then.
Correct.
If they
Refinance later, but don't count on that. I don't believe it's happening. You know, now is always the time.
There's always a reason to wait. Well, maybe there's a recession. There'll be a pullback in values, and I could time it and buy it low. Great. Buy some now and buy more then. You should always be acquiring these. The numbers work no matter when. It will never be the perfect time. It is a difficult thing to do, but as soon as you start pulling the trigger, you'll start to see those benefits. And the next one, you won't care about the market as much. You just know what you're adding to your portfolio. The next one, you care less and less about the market the more you do this because you can see the returns that you can get regardless of what the market's doing. The stock market goes up and down, and it's scary. Real estate, if you're a long-term investor, you can stick your money in it, park it, and sit back and enjoy the fruits of that regardless of what happens in the world. In fact, I would argue that as property values are going down or a recession happens, this is the best investment that you could continue to invest in during that time, much less through it. You want to know what helped get Clint and I through the last bubble burst? Boom. You're looking at it. Real estate. Examples like this. When he and I didn't have a lot of neither of us had a lot of income coming in during those periods. People weren't buying houses. We're in the real estate business. We had cash flowing rental properties that could see us through. Now, don't get me wrong. We have large businesses with a lot of different arms that generate revenue, but having that core of long-term investment properties, it's just a lifesaver through it all.
Agreed. So that brings us to our last point.
Yep.
So there's many different ways of getting started in real estate. So we're going to talk about how do you get started. And, we believe in having other people, having experts in your corner that can take care of it. Not everybody is going to be immersed in real estate like we are from the moment we get up till the moment we leave the office. So how? What do they do, Scotty?
Well, you and I both feel like there are enough turnkey providers in this country that you can find a good one in multiple markets. So don't feel like you have to buy where you live. Go to where the markets are strong, or more importantly, go to where you find a turnkey provider that meshes well with you, that you believe in, but most importantly, they have to have been in your business for 5 years or more.
Very important.
I hate, because everybody's got to start somewhere, and I hate to just set those people to the side, and I hope they make it those 5 years, but we just see such a failure rate over those first 5 years that it's just our advice that if they haven't been in business for 5 years, I wouldn't buy from them yet, even if they're the best out there. I just believe time is the most important factor in screening for a turnkey provider. And all you need is the down payment money. Like in that case, all that client needed was $25,000. And the turnkey provider, which in this case is one of our companies, provided them the property, has managed it every single time, every day, handles all of the maintenance. They just get a check every month and an emailed report. They don't get a check. It's wired to their checking account every month with a report on the property, breaking down any expense, anything else. And then they've got us as experts backing it up, as well as our team of licensed brokers, 14 licensed brokers that are focused on their property, managing it with more experience than I can count. So turnkey providers are the best way to do it, especially if you've got a full-time job or even a part-time job. It takes a long time to become an expert at this. Why not just let the experts do that? If you want to invest in stocks, most people go out and get a financial advisor. They're not going to dive in and do it all themselves. They might tinker, but the other way is if you don't have any money, you can always do some other methods. You can borrow hard money. There's a lot of ways to do that, but that's kind of a different audience, to be honest. And I don't want to.
And
get
that's
into
a whole
weeds.
nother. That's a whole nother show. And the majority of our listeners are going to be people that have other jobs and don't have the time. So we recommend turnkey, but it's not the only way. There's other ways out there. But that is our show for this week. We gotta wrap up. We've talked about rentals and how to profit from them. It was really cool to go through the math because I think that it's going to be something that our listeners are really going to be able to relate to, that you're not hitting it out of the park. You're being conservative. You're picking good properties in good neighborhoods, and it's amazing what that small cash flow number, what that turns into in 10 years. Mm-hmm. Don't chase the crazy numbers on paper because if it sounds too good to be true, it probably is. I'll say it again. If it sounds too good to be true, it probably is. We thank you for joining us. Please check out our website, homeboyspodcast.com. We got lots of exciting content on there. We got merch coming as well. Till next time, happy investing.